afternoon, and welcome to the Family Office and Petiole Asset Management webinar. Thank you for joining us today. My name is Hani Abu Ali, and I'm thrilled today to be joined by two distinguished market practitioners, David Darst and Naji Nameh. David's the former CEO of Petiole Asset Management and the ex-chief investment strategist of Morgan Stanley Wealth Management, and the author of a dozen books on investing and finance. And my colleague, Naji Nameh, is the CIO of Petiole Asset Management. The subject of this webinar is diversification. At its core, diversification is a powerful risk management tool that can provide portfolios with lower volatility, potentially, and higher returns than concentrated portfolios. Diversification can offer other advantages, such as avoiding local market biases, reducing correlation with the overall market, and optimizing your portfolio across multiple asset classes. To paraphrase Harry Markowitz, who is a pioneer of modern portfolio theory, portfolio diversification provides investors with a free lunch, since risk can be reduced without sacrificing expected returns. In fact, diversification is one of the investment pillars of the family office since its founding in 2004. We'll be covering this in this session. I'm going to start with a question to David, but this is an interactive session, and I'm going to ask you to put in your questions, and as we get your questions on this webinar, we'll put them through on our system and go ahead with it. So let's start first with my question to David. What's your definition of diversification, and what's been your experience over your long and distinguished investing career in public markets, David?
Hani, thank you. And Naji, it's great to be on with you. And I want to welcome everybody and thank you also for joining us today. Well, diversification is an investment approach. It seeks to reduce portfolio risk and add to, enhance, or augment investment returns by allocating investments among different kinds of financial instruments. You're talking about stocks, bonds, cash, precious metals, and private investments such as private equity or private real estate. Now, the point of diversification, it seeks to improve portfolio performance by investing in different instruments, asset classes, and even different geographical regions to gain exposure to different parts of the investment universe that will react differently to changes in fundamentals, such as economic conditions, such as interest rates, such as currency rates, to different valuation conditions, and to different changes in investment sentiment. In short, if you boil this down, with diversification, the investor is seeking to have some assets that go up in value or hold their value at times in financial markets when assets are experiencing price declines. Now, you'll see on this first slide, and do follow the slides if you wish, you'll see on the first slides, there's three major asset categories. There's capital assets, which are driven by the capitalization of income flows, stocks, dividends, bonds are coupons, and real estate is rental flows. The second is supply-demand assets. You're talking about iron ore. You're talking about coal. You're talking about oil. You're talking about natural gas. These are driven by supply and demand. And the third one is store of value assets. And they are driven by what someone else is willing to pay you for them. There you're talking about gold. There you're talking about antique automobiles. You're talking about art. You're talking about jewelry. Honey, I want to basically ask you what has been your exposure to diversification in private markets.
Thank you, David, for clarifying that. Look, the way we think about diversification and the way we practice, more importantly, is we think about uncorrelated returns to markets. We think about lower volatility, and we think about multiple asset classes when we come to investing at the family office and, of course, at Petiole Asset Management. So how do we do that? We do that by spreading that in the private markets across real estate, private equity and private credit primarily. And what that does is it allows us to lower the overall volatility relative to public markets, and at the same time capture some alpha, capture some return, as we see these investments as long-term investments. Because as you know, David and Naji, it's really the long-term style of investing where you're going to generate your superior returns. And what we found over many years of investing, particularly on private equity and real estate, is that's how you're able to generate it in the private markets by diversifying across geographies and across asset classes. So some examples is a business we've invested in the United States. About 2/3 of our assets are in the US, and about 1/3 is split between Asia and Europe, with Europe representing with Asia representing up to 25% of that balance. And we found that diversification has given us a lot of an opportunity to dampen the volatility in the portfolio. We can even talk about China today, which is emerging from the COVID crisis quicker than anywhere else. And fortunately, we've been able to invest. In fact, we're seeing a couple of exits this year in China because of this diversification. And that's been helpful to our overall global portfolio in private markets. Naji, maybe I can turn it over to you. Perhaps you can give us some color about your experience with local market biases and other observations you have of private markets through your years at the firm.
Sure, Hani, it was a pleasure, and happy to be here with you too on this webinar. So, I mean, to answer your question of home bias, it is very interesting because we live in a world of globalization, yet investor, we see a lot across the globe still favoring local assets over international assets. And they are sometimes missing on the diversification benefit. If you look at Saudi investors, and they tend to have their own businesses. When they buy Saudi real estate. When they go into stocks, they buy the Aramco, the SABIC, the NCB. We are in Switzerland. We see Swiss investors, again, the same principle. When they save and start buying stocks, they go into Roche and Nestle. UBS, when I was living in Canada, it was Canadian banks, the most favorite stock that people were buying. And, this is not, Hani, a new phenomenon. I mean, we've seen it for many, many decades. And the question is why? And, when I reflect on this, I think there are three reasons I can put on. The one is you have a familiarity to the investments that are close to you. You have a feel of control. That's kind of the first one, which is a very emotionally driven decision. The second one is a sense of informational advantage. You are operating in a certain market that's familiar to you, so you feel like you have more information to your advantage. The third one is a bit more the complexity potentially from investing outside of your local borders. You have a lot of potential tax complexity. I think today, and with the help of technology, I feel like the investors should look beyond their local borders. And my advice for them is to look at this in two main strategies for international diversification. The first strategy is when it comes to the liquid markets or public markets. Today, you have passive investments. They are not expensive. They are available. And we all know that public markets are relatively efficient and the information is available. So transactions costs are minimal. And therefore, you can go and apply a diversification in your international portfolio from a public side very efficiently. The other element when you think about diversification is not only investing in liquid markets, you want to also invest in illiquid markets. On that side, as we can still see, it is a very local market. Local execution is key. So on this, you want to be able to be quite active. If you are not able to be active as an investor, go and partner with people that are active. Back to you, Hani, I think that you have mentioned on our investment in China, and we noticed how a local presence is very important for private markets. And so going outside of your home bias has to come with a very clear execution. it is not just let's go and buy the assets that are outside. So from execution on the liquid side, I think the market is quite efficient. The tools are available. You go and pay cheap and buy passively. When it comes to execution on the private side, I think that's where you need to be quite localized. And I'll turn it back to you now, because you've experienced Asia for the past 20 years, and you've been, operating on private markets in Asia, and with the office in Hong Kong. I think we can give that experience of what is a local execution means really in practice when it comes to private markets portfolios.
Yeah, look, our experience, as you know, we've had an office in Hong Kong since 2010, so it's over 10 years now. And I think the really important point here is that you want to be in a situation where you're partnering with local talent. You want to build, especially in private businesses, you want to build your network based on knowledge, based on being in the local ecosystem, based on tapping access to talent and understanding local regulation, local tax, and other issues that are relevant to each jurisdiction. And I think it's incredibly valuable to have that when you have what we call boots on the ground. So we have people on the ground where we're able to go and visit a site. For example, in Japan, we made an investment a couple of years ago in Tokyo in real estate. We're able to go and survey that site, understand it, meet with the local builder, the contractor, as well as the local officials, and understand what that market looks like, and even meet with a few potential tenants as well as buyers of that real estate. And the same thing applies in China as it does in Australia, where we have that capability. And we've built over many, many years, some of which was also through difficult learning. We in this business, you make money, but you also on occasion have to feel the pain of losses. But those losses can be used to your advantage to learn about how to best do things the next time you invest. And who are the people that you trust, and how do you think about diversifying that portfolio over those markets? And that's been our experience in Asia, but we're doing the same thing in Europe today. I'm here in Zurich, and we're building as well a network that we already established with our London office many years ago, but now with our office here in Switzerland, over the last couple of years, we've been building our network here to understand this market and again, pick the best people with whom to partner. I think what's important, and not to be lost in this discussion, is make sure you're diversified, but you're diversified just enough and not too much. And really, I want to go back to David, because he's the expert in this. And perhaps you can guide us, David, on your thoughts on, is too much diversification also a problem? Does it really not solve the same thing that a concentrated portfolio does? And perhaps you can give us your insights and your experience on that, David.
Hani, great point. Over-diversification occurs when the investor increases complexity by adding more and more assets without actually lowering his or her risk or increasing his or her return. So over-diversification is not just about the sheer number of positions and investments that you hold. Listen, you can hold 5. Naji and I have talked about this for years, Hani, and you and I have as well. You can hold 5 different ETFs, exchange-traded funds or mutual funds, that all track the same stock market. They all track the Standard & Poor's or the MSCI Global Index. And basically, you are no more diversified than holding just one of them. Similarly, if you have a large group of investments that all react the same to changes in the economy or changes in interest rates or changes in oil prices, you actually have an assortment of like objects. You do not have a diversified portfolio. Too much diversification can definitely be counterproductive. And as you diversify a portfolio, you as an investor need to take account of and take this into consideration. Your age, your temperament. Are you a person that gets nervous if stocks go up or go down? Your life phase, where are you? Where do you have children? Do you have grandchildren? What is the objective of of investing and this capital that you're in charge of and stewarding. Your experience. Do you have a lot of experience? Do you follow markets and asset prices, capital inflows and capital outflows? Do you need your portfolio to generate income for you? Are you more focused on forgetting about the income generation, but more focusing on capital growth? Your time horizon, your reporting, your custody, and your security. And I want to emphasize this, the idea of security. In this stage of cybersecurity, it's very, very important that your assets be cyber secure. Honey, I'm going to turn it back to you after this discussion of over-diversification.
Thanks, David, for this illuminating and very clear description. I just want to add to the audience that we are taking Q&A, so if you have any questions, you can just pop them right into your box there, and we can start addressing those questions. And while we wait for that, Naji, you touched on in your earlier comments about this distinction between liquid and illiquid markets and diversification. Perhaps you could share with us your experience there and what's been from a returns and risk management perspective as CIO, what have been some good lessons learned and experiences you'd like to share?
Yeah, Hani. So I think just to reiterate what David was mentioning, and I mean, a lot of people think of diversification as numbers, and it's not about numbers, right? It's about having different assets behave differently. So you can have one ETF, all stocks, or you can have 25 stocks. You have the same diversification, yeah? So it's not about a number of 20 different lines in your portfolio. It's about how do you mix different assets together, right? And in that perspective, what we did a short study on, you know, an investor who has this evolution of investments, right? From, you know, you start investing in your local market, we said that's natural, and then hopefully you can go and extend it to the liquid market internationally, and then to the illiquid market. But you know, if I was to show you some data, since you mentioned risk and return, you're looking at, I'm sure you're seeing the slide, we are looking at a investor who had put in money in the Tadawul for the past 10 years. And if you look at the return that this investor would have made over the last 10 years, he would have made 5.5% return. And that's a reasonable return. Now, if you add to what does that return have come with, it has come through a lot of exposure to one economy and a lot of exposure to one currency, and it has come to an exposure to a lot of the oil price, which is one commodity. So while you're thinking you are diversifying into a local market that has several names, you're getting exposure to one commodity, one economy, one currency. Now, if you take the view that we talked about, let's go into a bit of international exposure and start with the liquid side. And here you have, you know, the Tadawul that would have given you 5.5. And if you go into a balanced portfolio, 50-50, you would see that a balanced portfolio would have given you 6.5% return over the last 10 years. So you already have improved your return by diversifying internationally. And we talked about that the execution of this shouldn't be too complicated. Buy 2 ETFs, that would be a good representation of a balanced liquid portfolio. And you're not going to pay too much for it, and you're not going to lose from an information advantage because you're buying the liquid markets, which are quite efficient. Now, let's add the illiquid to it. And if we add to the illiquid portfolio, and here we're talking about, you know, an investor that goes and put 1/3 of his capital in illiquid and the 2/3 in the liquid and Tadawul, then already your portfolio goes to from 5.5, what it used to be Tadawul, to a balanced portfolio with a liquid of around 9%. So you already have increased quite a lot the risk, the return, sorry for that. But the real question also is, okay, we have been able to execute also on the liquid. either ourselves by, what we do is we have these teams and they're executing on the liquid mainly with the local markets and the local offices. But then the real question which addressed diversification is what happened to the risk? We have seen an increase in return. Have this been followed by an increase of risk? So when you go and you look at the risk return perspective, you see that in this slide, we have the red is the risk, and that's kind of the risk for each portfolio. And you get to see that if you were only invested in Tadawul, you would have made 5.5% return, and your risk would be around 8.5%. And the portfolio that you would have built with private markets would have given you the best risk-adjusted return. And that is where it is the benefit of diversification, where you are able to optimize your return relative to the risk that you have taken.
Thank you, Naji, for putting that in numbers. There are questions just coming through, which is really a follow-on to this, is what percentage or share of liquid versus illiquid investments should you have in your portfolio? And you sort of touched on this earlier, but if you were to quantify it, what does that look like?
I mean, I would go back to what David mentioned, because it is not a science. It is much more about what are your investment characteristics as a person, which stage of the life cycle you are. If you are a young person investing, you can tolerate much more longer term investments, and therefore illiquid might be in your favor. But if you are somebody who is less and needing of liquidity, you might want to balance between liquid and illiquid, and maybe use the illiquid in terms of income generating illiquid. Real estate is one of them. Private debt is another one of them. Well, you're not sacrificing liquidity as much as also you're getting income. So it is not a scientific, it's very much about who are you, which stage of life you are, what's your capital inflow, and this list that David have mentioned.
Thanks. We're getting more questions. Sorry, go ahead, Naji.
No, because I wanted to ask a question to David about unless you want to take a question from the audience as well.
Go ahead.
Yeah, I mean, David. So you've been operating in this market for many years, and in a normalized environment, we all experience the benefit of diversification, and which means things go up, things go down. But in periods of market crises, market crashes, you would see sometimes that assets don't behave at their natural way of behavior, right? So what is the advice you give to investors as they have their diversified portfolio and they built it, but then the crisis hit and they realized that the diversification effect didn't work out the way they would like to work out maybe? What is the advice you would give them, having been through these episodes of crises where we know correlation can go up to 1 in different asset classes?
Naji, this is a very important point on our webinar addressing diversification, because during periods of heightened market turbulence and market volatility, you had 2 examples just in the last 12 years, the 2008-2009 global financial crisis, and of course, the spring 2020 pandemic lockdown crisis that occurred this year, especially bottoming out in March and early April. Several kinds of investments may all begin to behave the same way. This is known, as you just highlighted, as becoming highly correlated, Naji. And stocks, bonds, and gold all experienced price declines earlier this year during this pandemic as people had to sell certain assets, just the same way that the Russian nobility had to sell their furniture and burn their furniture and burn the art that was on the walls of their palaces as Napoleon was invading Moscow with the troops. They didn't care. They had to get some liquidity and they had to get some warmth. This is known as becoming highly correlated. What you said, correlations going to 1. Correlations normally range between 0, -1, +1. So when they go to 1, everything's acting the same. Now, safe haven assets during this pandemic crisis, such as the United States dollar, such as the Japanese yen, and believe it or not, Naji, Hani, certain technology stocks that were felt to be immune, just like you have vaccine immunity that we're talking about against the coronavirus. They were immune to this. Some of these big technology stocks, social media stocks, they actually went up in price. And so investors who had diversified portfolios were able not to jump out of the ship just as the ship is approaching the harbor and get panicky. They were able to stick to their investment plan, which you have highlighted for years, Hani, and you also, Naji, to have an investment plan. Mike Tyson, the famous boxer, he says everybody has a plan until they get punched in the face. And then the market was punching you in the face, but you needed a plan. And the people who had diversified portfolios, truly diversified, and a plan, they did not miss out one of the most powerful rallies in market history when asset prices have rebounded 70% or more. This is the indexes. Certain asset classes have doubled or tripled from their lows. So I'm going to turn it back to you, Hani, for your thoughts as we relate to the private markets. And questions coming in.
Yes, as we're getting the questions, maybe I'll take a stab at answering your question. I mean, I think it's a similar principle. Of course, it's not as fast moving as the public markets. So you're going to see the marks on a quarter by quarter basis in private markets. And particularly in real estate, you may not see a change in the value until either it's transacted or it's year end and they go through a formal process of evaluation. And so you're not seeing as much of that volatility, David, but what you are seeing is that if you're able to, in the same way that you discussed now, this concept of investing in companies that benefit from COVID, think about it in other forms of private diversification. So we looked at our real estate portfolio, and indeed, think about multifamily real estate in the US performed much better than office. Logistics, warehouses perform much better than office. Why? Because people are obviously, and companies are using and ordering a lot of stuff online. And so the value of warehouses and logistics assets increased while people stopped or at least reduced the trips that they've made to the office. And therefore, you're seeing occupancy rates on the office market come down. And that could be just a temporary phenomenon. I mean, I'm speaking with you here in Zurich. I'm in the office. I see Naji's in the office, and I see you've wisely chosen to stay at your home instead of coming to the office. But these are trends that we're very conscious of. And unless you've diversified your portfolio in advance of this, so you have sufficient exposure to office, resi, multifamily, warehouses, logistics, and other forms of real estate, then you're able to kind of weather the storm. And what's interesting is that we've seen even in our portfolio that markets that got hit hard by COVID, everybody's still paying their rent, right? Tenancy rates are quite the same, and actually occupancy rates haven't changed dramatically. And that's important because if you look at the REIT market for real estate in the US, that was reflecting a much bigger dislocation. Of course, on the very negative side, things like lodging, in which we haven't invested, hotels, retail, those are the sectors that got hit really hard. But maybe it's not a bad idea to be thinking about that as a contrarian today. Again, thinking as a diversified contrarian, maybe we should be thinking about those lodging assets as well as the certain types of retail, of course, right downtown and in shopping malls. There's a thesis to be had, and that's something. If you look at much bigger participants in the market like Brookfield, they were referring to that because they're picking up assets right now in this type of environment, which perhaps 3, 4, 5 years from now are going to be able to give them that breadth and the returns. And I think it's similar on the private equity market, where you've seen changes in behavior, and we're looking at companies that are including ourselves, the family office and Petiole, that are moving towards a very aggressive form of digitization and the transformation into digital. What does that mean for each company that's embraced that and pushed that through? And do you have enough of those private companies in your portfolio that are going to allow you to come out of this COVID stronger, rather than companies that kind of stuck to doing things the old way and perhaps may not be able to survive ultimately when we think through this? So it is important to be thinking about it in the same way on the the private markets as you would in the public. The only difference is it may take longer to show up. The distinction may take a lot longer to show up in your portfolio, but ultimately, if you're a long-term investor, you're going to get the benefits of that. And I think maybe throwing it back at you, and this is something that Naji and I, discussed the other day, but perhaps you're the better person to answer this, David, is do you think of this when you think about diversification, particularly in a public portfolio, is there a magic number? Is it 30 positions? Is it 40? Is it 100? Is it 70? How do you, this is a lot more art than science. I'd be curious to know what your thoughts are on this.
I think Naji highlighted this very well. Also, Hani, the number is a strict number. Now, people say 30, 40 positions and all the way up to 100 positions is way too much. Warren Buffett has constantly stressed portfolio concentration to build wealth, portfolio diversification to protect and preserve wealth. I think your number is going to be very determined by your personal circumstances, but two or three or five is probably way too small, and something above 20 is probably way too large. You're losing track of things. You're not properly watching them. You're not properly taking account of them. I just want to say that it's important for investors that are listening into this call and watching this webinar that the investment philosophy that we have here at the family office and at Petiole Asset Management consists of three main pillars. Number one is that asset protection is paramount. The second word of our philosophy is protection. So we always are looking not only what are the returns, but what are the risks? And then we get into what are the correlative risks. Harry Markowitz, whom you mentioned a minute ago, he won the Nobel Prize for his 1950 essay in which he says that risk is not variance. Everything moves up and down in life, everything. Risk is covariance. Risk is when everything acts together, and you don't want everything to act together. That's the major theme of this webinar and of our investment philosophy. Secondly, correlations are critical. That's this idea of you want some investments that when then part of your portfolio is experiencing momentary, we hope, price weakness, that others are holding their value or increasing in price. And the final part, which we constantly talk about every single week, every single month, the three of us, all assets are driven by a combination of fundamentals. That's interest rates. That's the economy. That's profits, okay? They are driven by valuation, and valuation is basically price to earnings, price to book value, price to sales. There's all kinds of valuation metrics. And most importantly, assets are driven by investor sentiment and investor psychology. And the times when you can make a fortune is usually when the markets and market values are very depressed. There's despondency, there's despair. And the time when you can lose your shirt is when there's excessive euphoria and excessive optimism. So we monitor at the family office, Petiole Asset Management, we monitor very, very carefully, because at major turning points, 80% of the driver is psychology. People forget about fundamentals and valuations when we're in periods of great enthusiasm or great despair. With that, I'll turn it back to you, Hani, and to you, Naji.
So thanks, David, for summarizing that so eloquently. Naji, we're getting a couple of questions here, a few questions actually, and one I thought perhaps you can answer. This question is about corporates and PE, and the question is, how do corporates look at diversification? Isn't it better for them to focus on what they're good at rather than diversify? Because the shareholders are going to insist that they focus on their core competencies and pay out their dividends rather than diversify, because shareholders themselves can diversify. How do you think about that?
Great question, Hani. I think if we address it on the corporate first and then on the private equity second, a lot of the corporates, what we have seen, they, in periods of excess liquidity, they diversify. And unfortunately, many times they diversify away from their core competency. And you and I, we know of many transactions which we have done where we took advantage of these excesses that have happened. And we call these the typical carve-outs, yeah? When a company end up being really good at something, but then there is excess liquidity and they go and carve out into something, another industry, another division that they don't manage as well. So definitely corporates, it's much better that they are having a core competency and they grow from their core competency rather than going and adding other competency. And what we've seen is, you diversify your client base, you go into new markets, but with the same product, with the same core competency. And on the private equity side, most sponsors don't think of diversification the way we are discussing it. I think that sponsors, they think of it from a company by company and how they can add value to these companies, which is fine. They typically range between 8 to 12 companies in a private equity portfolio. And as an allocator or an investor, you need to be aware that, having one exposure to one single fund is not enough. You need to diversify. So the asset allocation, when it comes to real estate, private equity, private debt, is on you as an investor because the majority of the single private equity managers are focused on a company by company story and how they add value, which is again fine. So I think the answer to summarize is better for corporates, private equity sponsors to focus on their individual core competency and manage those companies very well. And as an investor, it's very important that you diversify because you're not going to put all your eggs with one sponsor.
Thank you, Naji. And as we wait we do have actually a couple more questions, and I want to just remind the audience that we're going to probably be wrapping up in about 4 or 5 minutes. I'm looking at another question that came through here that's trying to, refers back to your Warren Buffett comment, David, about creating wealth versus preserving wealth. And the really, I guess the question, if I could paraphrase it, is what are the common mistakes and pitfalls you've seen with people over diversifying is really the gist of that question.
Well, it's great, Hani, and thank you everyone for sending in your questions. I would say one of the most common mistakes I've seen is falling in love with your investment. Okay, if you have an overly concentrated investment, Naji, falling in love with that investment and letting it dominate you in every aspect of life, in your family life, in your business life, in your athletic life, in your artistic life, in your creative and spiritual and religious life. You need to have balance. You need to have balance. And I think one of the biggest mistakes that I've seen is that people that get unbalanced. They get financially unbalanced. They get emotionally unbalanced, and they get psychologically unbalanced by perhaps falling in love with an investment. Second thing is you have to take time to consider and then act decisively. And there's different ways of acting. Naji, you and I for years have discussed when you're adding money to the markets or taking money out of the markets, do you do it all at once or do you do it in sequence and space it out over time? So you have to think about, that's another big mistake, is that people make sudden moves, honey, sudden moves. And diversification, and the whole point of this webinar is to give you the deep keel of a boat, to give you the balance, the ballast to prevent little waves from becoming oscillated and becoming so big that you get paralyzed and you do the wrong thing. That's the major mistake that I see people making through the years of helping them and observing them.
Terrific. Thank you, David. That's very helpful in learning. Gentlemen, we've come up to the end of our webcast. We have taken a good number of questions from the audience. So I want to thank the audience for their participation and thank them for joining this the Family Office and Petiole Asset Management webinar. I'm looking forward to our next webinar, which will be in January, when we'll be hosting a couple of our sponsors. They'll be looking at the outlook for 21. We'll be feverishly working through the month of December, thinking about how to position our clients' portfolios into the new year, and we'll have some thoughts on that as well. I'd encourage you to dial into the next webcast. We will be sending out invites over the next few weeks as we get closer to the date, so please register for that as early as you can. And I want to thank you, David Darst and Naji Nameh, for your wonderful, eloquent, and illuminating insights over the last 41 minutes, and look forward to our next conversation. Thank you all for your participation. And this concludes the webcast.